Well, in the oil market, traders are monitoring the latest headlines out of the Middle East. Israel rejecting a ceasefire proposal for Gaza while also taking control of the Rafah border crossing. Geopolitical jitters have not influenced oil performance of late, with a few factors, including on the supply-demand front, seeming to result in prices cooling, certainly from their more than $85 U.S. a barrel level in New York a month ago. Looking at the quote today, we seem to be right around the lowest level in nearly 2 months. Now, across Wall Street, there is also a focus on the broader global supply story. There is a growing view amongst the banks who track the oil story on Wall Street that Saudi Arabia and its OPEC Plus partners will choose to maintain their roughly 2 million barrel a day output curbs when they gather in Vienna on June 1st. But let's put all the pieces together. For more on the oil outlook, we're joined by Eric Nuttall, partner and senior portfolio manager at Ninepoint. Good to see you.
Good to be here.
Okay, so a lot of moving parts always with oil, but I guess I'll start with oil basically at the lowest level in 2 months. What do you think's been going on?
That's right. So I think what we've had is the removal of any geopolitical risk premium that was in the price, which honestly for energy investors is a good thing. You don't want to have a large premium because then there's always this worry about, you're worried about headline risk, and if some peace treaty, comes to pass and oil falls $5. So when we look at price relative to global oil inventories, we can now say that there is no risk premium. And so that's a good thing. As we're heading into the summertime, seasonal demand will uptick. We have inventories falling to their lowest levels in history by the end of this year. So that's very, very supportive of about an $85 to $90 oil price, which is why we're using 80 in our investment decision making. So I think it's really been the calming of tensions somewhat. The view that even if there is ongoing conflict, that there won't be an actual supply disruption to oil.
So when you say 80, you're basically, when you're doing all your math, you're working off of, for WTI, give or take an $80 level
Yes.
for the year?
Yes. Yeah.
Okay.
Yeah.
Now, I mentioned the market also keeps tabs on what major producers are doing, and we'll wait for an update, call it in a month's time, a little less than a month's time. But I was even reading a story today citing the Russian deputy prime minister, maybe sort of exploring the idea of more output. Yeah. I just literally read to our audience that, Wall Street is betting on, maintaining those curbs.
Yes.
What do we make of the collection of countries that make up OPEC Plus?
So there's always dramatics heading into any significant OPEC meeting. And I think His Royal Highness, the Minister of Energy of Saudi, likes to keep people on their toes, keep speculators on their toes. And so you typically will see trial balloons released. Maybe we're going to do this, maybe we're going to do that. I don't think they've made up their mind. They typically don't until, the event actually takes place. From my perspective, I think you'll see the continuation of them being preemptive, precautionary, and proactive in terms of managing oil supply. I think there is still lingering concerns about the role of high interest rates in the world. We're seeing the U.S. consumer faltering a little, Starbucks and McDonald's and such. So I think there's enough cover or reason to be a little cautious still on them keeping barrels removed from the marketplace and waiting for the market to pull that production from them rather than them pushing those barrels on. And that's a really, really important distinction. If you push barrels onto a market, you're essentially pushing down price. If you allow them to be pulled from you, that's price agnostic. And eventually, I think in a year's time, as the barrels are pulled from them, the market narrative is going to switch back to shrinking OPEC spare capacity, insufficient investment, and a very, very bullish outlook for oil in the next 2 to 3 years.
Well, on the subject of bulls, we should remind our audience, many of them know, that energy stocks as a group have been the best performers on the TSX this year. The price of oil is still up, I think, about $10 a barrel in New York from where it was at the December lows. For the Canadian players, I mean, you said you're kind of working off for WTI, call it an $80 level for this year. Remind us again what prices allow for the Canadian producers to be running healthy businesses.
So it's interesting you point out the strong performance because energy remains contrarian. Energy sentiment remains very, very poor, which is confounding to a lot of us that are shoulders deep in the details. So at $80 oil, this sector is generating the most amount of free cash flow in its history. We have the sector trading at a 14% average free cash flow yield at $80 oil, strip forex, current tight differentials, et cetera. And what is exciting or should be exciting to people is that given the past 2 years of deleveraging, more and more companies are finally reaching the inflection point to return all of that free cash flow, or almost all of it, back to shareholders. And so you have the Athabascas, the C&Qs, returning 10, 11, 12% free cash flow yields per year. And they can do that for decades because they're sitting on 20, 30, 40, 50 years of stay flat inventory.
Yeah. And then on top of that, we have a pipeline expansion, which seems ready to go now. Yes. So that maybe opens the door for some better pricing for Canadian producers. And before I let you go, I saw some comments from the CFO of MEG Energy on the company's conference call today about just the considerations for their own capital. I think they were talking about possibly implementing a base dividend as a way to return cash to shareholders. Yeah. MEG's a good example. You know, they're watching debt levels too, but you have a lot of these conversations with management at these companies about how they're allocating their capital as well. What do you think the future looks like? Yeah,
we've had conversations with MEG. So our view is every company should have a small base dividend that opens the door to more potential investors, leading to re-rating. But given how profoundly mispriced the sector remains, by our estimates 30 to 50% on average per name, the mass usage of free cash flow should go towards buybacks until they drive a re-rating, at which point this sector, I think, is going to be a low to no growth sector for many, many years to come. And so the allocation of that capital will at some point go from buybacks to variable dividends. It's not the most eloquent solution, but that'll be after achieving a re-rating. So for now, it's meaningful buybacks. You're seeing more and more companies do it. And those that have done it meaningfully have seen their stock prices massively outperform. So the playbook is there. The playbook is obvious for what the sector should, will, and is following.